Hello, good afternoon, everyone. And this is our first session as a new committee, new council year. We have this year our Honorable President, C. Aniket Sunil Talati, who has taken up his presidentship on 12th February 2023, and Vice President, C. Ranjit Kumar Agarwal. Friends, this especially the Sky High Symposium we have started last year, and I am very happy to share with all of you that we have successfully completed 40 sessions of Sky High Symposium in year one. And continuing the trend, this is 41st session of this Sky High Symposium. The committee with the vision of new president. There is the restructuring of this committee. Earlier, it was only women members empowerment committee, and now this is women and young members empowerment committee. However, we are proposing to change the name of the committee, keeping women and young in that as it is, but maybe the word empowerment we want to rename, because now we feel that all are empowered, so we may replace with some another word. And I request all of you to please share your thoughts ki whether this word can be replaced by excellence or some other word, so that we continue the committee, women and young members, that committee, because we feel that empowered, we all are empowered, and we need to really change this word. Again, I have been given the charge of Sustainability Reporting Standard Board, and also Vice Chairperson of Valuation Standard Board. So these are the primary responsibilities. Again, I am member of the Board of Discipline, where all the cases relating to Schedule 1 of our Ethical Standard Board, our Code of Ethics of CA Act comes over there, where the decisions and the members against whom the complaints are filed, the cases are coming. So these are the basic primary responsibility. However, I am there in various other committees. Our call center is working very super duper in excellent way, and more than 1 lakh calls we have answered. So majority calls are relating to the members as well as students. Majority are relating to students. So I am happy that the institute is catering the services in the best possible manner through this call center to the members and the students. And feeling so happy because I was the main architecture behind this call center. Of course, now in this committee, we have our vice, I am the chairperson of this committee, and we have vice chairman as C. Abhay Chajed. And I have been promoted from vice chairperson to chairperson to this committee. And C. Abhay Chajed was also part of our team of a call center. He is also joining very soon. He is there in the meeting. And we have today, the budget has recently been announced by our Honorable Finance Minister. And we have today with us a very dignified and knowledgeable and my mentor, I can say, guide, the speaker for the today's session on this finance proposals which has come relating to direct tax in the budget, and analysis which will be shared by her. So I welcome CA Neenabin Pradeep Kapasi to this platform. I really thank her for taking this session, and your valuable knowledge will definitely support and upgrade the knowledge of all the women participants. So welcome, madam, over here. I also welcome all my dear coordinators, the moderators, CA Rupa Ben Ghami, CA Ami Chheda, CA Hetal Ghada, and CA Mansi Mishra, who are very well coordinating these sessions. Want to take maximum benefit of CA Nina Ben, from her session. So now I request the coordinator to please share. There are a lot of things to share with all of you, but we will have a separate session. Again, we are also planning to celebrate International Women's Day on 7th March, because 8th March is a holy. So on 7th March, it will be virtual, and 18th March, we are proposing to celebrate in the physical form. So please mark your calendar, block your date. We have changed the timings from 5 to 7 to 4 to 6, because we feel that this will be more suitable for all women friends, and hence accordingly we have rescheduled this time for all of you, so that you can maximum numbers of our participants can take the benefit of this sky high symposium. With these words, I once again welcome the speaker, coordinators, and my special audience, beautiful, intelligent ladies. And my special thanks to our secretary, C.A. Shanu Goel. With these words, I request the coordinator now to please give the brief introduction of our honorable speaker, C.A. Nina Kapasi.
Thank you, Preeti ma'am. I hereby take this opportunity to introduce our first learned speaker for the day, CA Nina Kapasi. She's a practicing CA specializing in taxation, audit, and managing consultancy. She's also a law graduate from Government Law College. She's a core group member of BCAS and speaker at various seminars, workshops organized at ICAI, WIRC, BCAS, etc. She's a contributor of articles in magazines and newspapers, including BCAS, Referencer, Economic Times, Times of India, etc. She's co-author of Outlook publication, Layman's Guide to Income Tax. She's also co-author of Handbook on the Role of Women Directors, published by ICAI in 2020. She is an independent director in Apar Industries Limited and also a trustee of Akshara, an NGO engaged in women's issues and pioneer in Helpline 103. With this brief introduction, I welcome you, ma'am, for today's session.
Over to Nina Ben now.
Yeah. CA Preeti Savla, Chairman, Women's and Young Members Empowerment Committee, CA Ami Cheda, CA Shanu, Rupa Ben, Hetal, and all other participants on the digital side. Thanks for giving me this opportunity to study the budget in detail, because otherwise it would have taken 2-3 months to go through 100 and odd amendments, which are really relevant for our day-to-day practice. Now, coming to the subject proper, I'll share my PPT. So when Finance Minister Nirmala Sitharaman, what's that? We can go. Yeah. When Sitharaman, she introduced this budget 2023, the thrust is on inclusive development with sustainable growth. However, while presenting the Finance Bill 23, one can, yeah, I'll put it in slideshow mode. Yeah. So is it okay? Yeah. So now, but when we go through the various amendments introduced by the Finance Bill 2023, one can make out the thrust is on simplification of the tax rates, the lowering of the tax rates by providing new tax regime, taking care of new developments in economy and plugging the loopholes so that the litigation in the future can be reduced. With this, we'll go through each provision one by one. There are, as I have told you, that there are 102 amendments, and if we consider sub clauses, it may go beyond 200. So we will take whatever is important for our day-to-day practice. Now coming to the first subject, it is rates of tax. There is no change in the rates of tax SC and EC for AY 23-24. AY 24-25, there is a major change as far as individuals and HUFs are concerned. There is no change as far as old regime is concerned, but for when you go for a new tax regime under section 115 BAC, there is a substantial change which we will see. Even the surcharges also change. Tax rates and surcharge and sales for companies, firms, LLP also remains unchanged in both the regimes.
Neena
Tax
ma'am.
rates, yes. Yes,
Yeah,
Amin.
yeah, sorry to interrupt. Can we have Abhay sir to address our participants today just for a
Yeah,
few
please.
minutes?
Yeah.
Thank you.
Please.
Abhay sir.
No, I think, yeah. Thank you so much. But I think let Neena madam continue. Maybe I think once she completes her part, then maybe I can, address in between. So I think let's not stop her because that flow I think should continue. So madam, I would request you to continue. Once you finish before the next speaker, maybe I'll come in between for a few minutes. Thank you so much.
Thank you, sir. So now this tax rates and surcharge and sales for companies, firm, LLP also remains unchanged, whether in new or old regime, not new and old regime, but in other various conditions. Tax rates and surcharge for cooperative societies also remains unchanged. However, there is one additional incentive introduced for the new cooperative manufacturing society, which has been set up on or after 1/4/2023 and which commences its manufacturing production on or before 31st 3/24. Subject to fulfillment of the conditions, the tax rate will be applicable is 15% as compared to the normal rate of 30%. New tax under section 115 BBJ has been introduced for online game winnings, which is now so much of prevalent that one has to control it or otherwise one has to generate revenue which is due to the government treasury. So 30% plus applicable surcharge and cess has been introduced, and along with that even the provision of TDS has been implemented. As far as AY 23-24 is concerned, one has to remember that still old tax regime is going to be default regime. But for AY 24-25, new tax regime is going to be the default regime. So if one wants to adopt old tax regime in AY 24-25, one has to file form number 10IE or any other form which may be prescribed before the due date of filing return of income. Now this concessional rate of tax has also been made applicable to AOP, BOI and artificial juridical person over and above individuals and HUFs who were eligible since AY 21-22. Rates of taxes for individuals as per 115 BAC, one will see that it is even as compared to AY 23-24, the rates in AY 24-25 has been reduced, plus the slabs have been cut down from 6 to 5 slabs. As far as non-business assessees are concerned, they can opt for new and old on year-to-year basis. However, in case of business assessee, the change can be happened only once, and once it is changed, one cannot go back to the original tax regime. So this care one has to take while selecting whether to go for old or whether to go for new, because if there is a lot of hue and cry that new tax regime is very beneficial. However, in few of the cases, if one considers in certain slabs of income, even old tax regime, considering that you are availing all the deductions under chapter 6A, plus when you are having an interest on housing loan up to 2 lakhs rupees, the old tax regime may be beneficial. So before jumping to new tax regime, one should take a considerable view in case of a business assessee. As once you have gone to new tax regime, you cannot shift to old tax regime, but only once. Here, the benefit as far as new tax regime is that the surcharge is reduced from 37 to 25% on an income of more than 5 CR, which makes highest tax rate at 39% as compared to 42.74% under old regime, having a substantial savings of 3.7% on highest tax rate, very substantial. Rebate is also increased from 15,000 to 25,000. That makes the income of rupees 7 lakhs tax free in the hands of individuals. One more thing is that even in case of from the slab rate between 10 to 15 lakhs, where the tax rate is 30%, it is reduced to 20%. From AY 24-25 and not from AY 23-24, standard deduction will be eligible up to rupees 50,000, and deduction of professional tax will also be applicable. Even in case of a family pension, 1/3 of family pension or 15,000, whichever is less, will be eligible for deduction. There is one more that deduction with respect to amount contributed to Agniveer Corpus Fund that we will discuss as and when the topic comes. There is no change in health and education cess, which continues at the rate 4%. Now I have given this tax regimes bit AY 22-23 and AY 23-24 under section this 115 BAC. If you see, the slab is absolutely standardized. Like up to 3 lakhs, there is no tax rate. 3 to 6, 5, 6 to 9, 10, 9 to 12, 15, 12 to 15, 20, and above 15, 30%. As compared to AY 22-23, where there are 6 slabs. Even tax rates, if you consider, this 12 lakhs, 50 to 15 lakhs, it is at 25%. Whereas in case of, 10 to 12 lakhs rupees, it is 20%. Whereas under from AY 23-24, it has been reduced to 20%. So to that extent also, the same is beneficial. And the move is surely towards simplification and towards lowering of the tax rates. This I have given 115 BAC comparison between old and new. It is just for reference. You may go through the same at your convenience. Surcharge I have given. Special rates under various types of income, say for example, short-term capital gain, long-term capital gain. Long-term capital gain is subject to STT. I have given for the purpose of reference. Now coming to the salary income. Rent-free accommodation provided to the employee by an employer is subject to subject to perquisites and includable in salary income. So the same has to be computed as per Rule 3. Similarly, accommodation is deemed to be provided at a concessional rate if the value of accommodation computed is exceed the rent recoverable or payable. So this is now changed that, instead of having that Rule 3, they will provide us a manner in which this computation has to be worked out for rent-free accommodation. The notification will come at a later date. The section is providing for the change. Similarly, when this value is exceeding the value of rent recoverable from the employee, the difference will be considered as a perquisite in the hands of an employee. The finance minister at this time of presentation of budget has referred to hiring of the limit of leave encashment, the exemption of leave encashment under section 10A up to rupees 25 lakhs rupees, which is at the present it is 3 lakhs rupees on retirement in case of a non-government employees. In case of a government employees, the same has already been extended to rupees 25 lakhs rupees. So to make this comparable, the budget speech made reference of increasing limit to 25 lakhs rupees. However, one did not find any amendment in the finance bill, but while finalizing the bill, while it becomes act, the amendment will surely come. Coming to the business income, there are many good number of amendments here which one has to consider. Now, section 28(4), which one is aware of, there is that whatever is the value of any benefit or perquisite, whether convertible into money or not, arising from the business or exercise of profession, is to be considered as a business income. Now, you all are aware that whatever is, sales promotion gifts given to the dealer or distributors, or foreign trips organized for agents, etc., used to be claimed by the organizing entity as a business expenditure. However, in the hands of the person who used to receive this benefit or perquisite, it used to go scot-free. So to cover this kind of income, the section 28(4) has been amended, but in the AY 21-22. But the scope is still expanded and clarified to include cases where benefit or purchase is provided in cash or in kind, or partly in cash and partly in kind. The issue has arisen on account of Supreme Court judgment in case of a CIT versus Mahindra and Mahindra 404 ITR 1, where it was decided that any benefit to be taxable or perquisite to be taxable, it has to be in kind, because if it is in cash, it will be covered by 28(1) only. So to cover this anomaly, or to cover this kind of transactions, the Act has been amended to cover even when the benefit or perquisite is provided in cash. Now, not only this, there is a consequential amendment which is done in section 194R, which makes it liable for TDS. Rather, it is section 194R circular number 12 dated 16 June 2022, where the reference has been made that when the such perquisite has been paid in cash also, the TDS should happen under section 194R. While section 28(4) did not cover this kind of taxability. So to cover this anomaly, where the 194R, which is the TDS section, covers this situation, but main section does not cover, this section 28(4) has been clarified to include perquisites which has been paid in cash or in kind, or partly in cash and partly in kind. So this may result into many cash things covered by this. Say, for example, cash discount, cash transfers, or loan waiver of loan, etc. So, and secondly, these all are liable section 190 for TDS under section 194R. Not only that, non-deduction of TDS under section 194R is also considered as an offense and liable for prosecution under section 276B. So please be very careful while examining this business perquisite under section 28(4). Not only that, for practicing chartered accountants like us, when we are reporting for tax audit, we are reporting under TDS compliances under various clauses of 3CD. So here one is also required to examine whether such benefit or perquisite have been provided, whether TDS has been deducted. So as a tax practitioner, one should be aware of this provision. The next is preliminary expenditure. Now, any expenditure to be amortized, on project reports, surveys, feasibility reports, existing condition requires that it should be either on self-spending or it should be spent by an approved concern by the board. So, however, now is amended to provide that if the assessee furnish a statement containing the particulars of expenditure specified in this clause within such period and within such prescribed form and manner, then these expenses will be eligible. So these limitations of expenses on self-work or through approved concerns have been removed. This shows the trust which the department is imposing on their taxpayers, and one should, I think, also honor this by adhering to this trust. Rules will be prescribed for allowance of preliminary expenditure and for submission of a statement. Now, definition of NBFC is given in section 43B DA and section 43B D has been substituted with NBFC as notified by CBDT. Why? Because it is not as per the asset classification followed by RBI, not followed by CBDT. My mistake, it is followed by RBI. So the NBFC will be notified by CBDT, who will be eligible, who will be covered by section 43B DA and section 43D. Now this is something which is very necessary. We'll spend some few minutes on this. With effect from AY 24-25, under section 43B, a new subclause H has been introduced to cover any sum payable to micro and small enterprise beyond specified time limit allowed as reduction only on actual payment. You all are aware that section 43B, as compared to our regular accrual method of accounting meant for businesses, certain expenses are allowed only on actual payment. The section has started with a statutory payment such as customs duty, sales tax, estate duty, etc. And finally, then it moved to socio-economic thing also, such as EPF payment, leave encashment, bonus, etc. In this category, the payment which has been made to this MSME is also micro and small enterprise have also been covered. Now, then what is the time limit? The time limit as per section 15 of the MSME Act is 45 days if there is a written agreement, or 15 days in other cases. So if there is a written agreement, one has to make 45 within a period of 15 days or whatever the date is provided in the agreement, but not exceeding 45 days. So even if your agreement with your buyer is more than of 60 days, however, MSME Act does not recognize period beyond a period of 45 days. So if any payment has been done beyond a period of 45 days when there is a written agreement, or 15 days in other cases, such deduction is not lost, but it will be eligible only when the payment has been done in that financial year. So now generally section 43B covers the cases where the payment is not done before the end of the financial year, but before the due date of filing return of income. And in such cases, the payment is eligible as a deduction in the year of accrual. However, this proviso is absent in case of this payment to MSME, which makes that, say, for example, in AY 24-25, if you have incurred a liability of 1 CR for a payment of business, for a payment of materials, and if you have not paid within a period of 45 days, and if you happen to make the payment in the next financial year, the payment will be disallowed in AY 24-25, but you will be able to claim in AY 25-26. Now take a case of a small manufacturing company where 80% of the expenses are comprised of purchase of materials. Now this kind of disallowance in 1 year and allowance in another year will totally disturb the tax computations of the entity and may in fact draw this to the unnecessary financial trouble. Now what is written agreement? When business is concerned, in day-to-day business and day-to-day transactions, you don't go through the written agreement. So whether invoice where you are specifying the time limit, whether it will be considered as a written agreement, in my humble opinion, yes, because somewhere the invoice is binding on both the parts once the party accepts the material or the services, In such case also, it is considered as a written agreement. But as I have already informed you, period beyond the 45 days will not be valid, and the payment has to be done by within a period of 45 days. Now, what is micro enterprise and what is small enterprise? The definition is given as per section 2H and section 2M of MSME Act. Micro enterprises are such where the investment is 1 CR and 5 CR is turnover, and small enterprises are 10 CR and 50 CR. I would like to draw your attention, when you talk of MSME, it talks of micro, small and medium enterprise. But when you are referring to the section 43B subclause H, it refers only to payment to micro and small and not to medium enterprise. Okay. So if one defaults for payment to medium enterprise, one is not covered by this, only in case of a micro and small. The second point where I would like to draw your attention is that it is not that large or medium enterprise making payment to micro and small beyond the period of this section 15 of MSME Act will qualify for disallowance. It is not so. One micro enterprise making payment beyond period of as per section 15 to another micro enterprise or another small enterprise or for the will also qualify for such disallowance. So here is the real catch where one has to take care of this. Now, what is micro and small enterprise? We are aware the definition has been given section 2H and 2M. Whether they are those who are fulfilling this or whether they are those who are registered under MSME Act. So in case of a Silpi Industries, Supreme Court held that the benefit of interest under section 15 of MSME Act will be eligible only for those MSME which are registered under MSME Act or, as we are aware, under Udyam. So considering that not all this 43B will not be applicable to the payment to all MSME, but only those MSME which are registered MSME Act. Now, as I had discussed this matter with some of other chartered accountants, and they were talking about some unfair business practices or maybe safe business practices adopted by a few of the large companies. While dealing with small units, MSME industries, micro and small enterprises, they take an undertaking from their vendors that they are not registered under MSME to avoid this kind of issues. There is another issue also which is a existing position under 3CD, where we have to report for under clause 22 of form 3CD, where the interest inadmissible under section 23 of MSME Act, which we need to report. Yeah, so to take care of all these things, they take an undertaking. So large industries or large companies, they will surely take care of them. It is only with this kind of provisions, it can be harsh on small and medium enterprises rather, who don't have expert advice to their disposal. Now, but the issue may also arise that when you have entered into an arrangement agreement with them, they are not registered, but they have been registered post contract. What will happen? Whether they are covered by this 43BH or not, there are few controversies which one has to go through, one has to study well. Presumptive taxation and tax audit. One is aware that under section 44 AD, eligible business is where you are having a turnover up to 2 CR, and when you are having when you are offering income at 2%, 6% or 8% of the turnover, in such cases you don't have to maintain your books of account and neither you have to get your accounts audited. Now this threshold of 2 CR has been extended to 3 CR, but with one additional condition that cash receipts should not be in excess of cash receipt should not be in excess of 5% of aggregate turnover or aggregate gross receipts, whichever is applicable. However, expenses limited of 5% of total payments is not applicable to them, and check or draft drawn on a bank which is non-account pay will also be deemed to be cash receipts. Similar threshold extension is also given to professionals under section 44 ADA, where the threshold of rupees 50 lakhs has been extended to 75 lakhs. Again, the same conditions that when cash receipts should be less than 5% of gross receipts. Here again, same that the payment, if you are exceeding more than 5% in cash payments, it will not get affected. Checks or draft drawn on a bank or non-account paid checks, similar condition deemed to be cash receipts. If more than 5% cash receipts, existing limit of 50 lakhs will continue. So with effect from AY 24-25, if you are covered by 44 ADA or ADA 1, there is no tax audit liability under section 44 AB. So here we are having an interesting situation. This is not coming out of budget, but just generally what is the condition at the moment, existing conditions, and what are going to be the amendments. So now, as you are aware, turnover of rupees 1 CR, there is not going to be any tax audit. When you go to 1 CR to 2 CR, your income is more than 6% or 8%, whatever is applicable, no tax audit, even more than 5% of cash receipts. But when you go from 2 CR to 3 CR, and if your income is more than 6% to 8%, no tax audit, only if cash receipts equal to or less than 5% of aggregate turnover or gross receipts. Now 3 CR to 10 CR, no tax audit if your cash receipts and cash payments are equal to or less than 5% of aggregate turnover gross receipts. Here, the condition of income should not be less than 6% or 8% is not applicable here. So growth in case of gross receipts is less than 50 lakhs rupees, no tax audit, even if the income is less than 50% and even if cash receipts are more than 5%. In case your gross receipt is exceeding 50 lakhs to 75 lakhs and income is 50% or more, no tax audit, only when cash receipts are less than 5%. And if income is less than 50%, tax audit is must in all the cases. Now coming to capital gains. The interesting thing has come into this electronic gold receipt. The government wants that this gold market should be digitalized and should be so that it will have footprint of the movement of gold, and it should not be it should be well regulated by the authorized agency, and SEBI has been appointed as a sole regulator in this behalf. We all are aware that sovereign gold bond as an investment in place of a physical gold, for a proper purchase of gold, as an investor, if we want, we can have sovereign gold bond, we can earn interest thereon also, and we can dispose it off without losing any loss in gold, what we normally do at jewelers end, where we lose at least 5 to 10% of gold. So sovereign gold bond as an investment has been turned out to be a good investment. Similarly, this electronic gold receipt has been introduced by this budget. Now what it is? So if you are depositing your gold in vault, that means a SEBI regulated agency for electronic gold receipt, that is known as a EGR, or you are getting physical gold against surrendering or of this EGR, this conversion of gold into EGR and reconversion of EGR to gold is going to be tax neutral, because from the definition of transfer under section 47, these transactions have been excluded. with that, under section 49, cost of acquisition is going to be historical, as this is going to be tax neutral. When you are, say for example, when you are selling when you are when you are selling EGR on your exchange, on recognized exchange, because it is also going to be listed in a recognized stock exchange, then here this cost of EGR will be the cost of gold which you have deposited in vault for getting this EGR. Similarly, when you are selling gold which you have realized from the surrender of EGR, the cost of gold will be the cost of EGR which you have surrendered and for which there was no transfer. With the result, even the period of holding is going to be the date of acquisition of gold or EGR which was originally, which was the origin, which was not considered as a transfer. There is not going to be any tax on capital gain on such conversion. And I understand that interest income is also going to be exempt. Now this is very interesting thing. This is something like known as a market linked debenture or MLD. This section 50 AA has been introduced. Now what was this market linked debentures? These are basically debt securities which are secured in the market. Though it was a debt security, the returns were linked to the underlying indices. Say for example Nifty or Bank Nifty or some indices, and whatever one used to get, it used to be considered as a long-term capital gain or short-term capital gain based on the period. And if the period was extending more than 24 months, in that case it was a long-term capital gain, and because it was a listed, the long-term capital gain tax was leviable at the rate of 10% without indexation under section 112. That was the entire thing. Now MLD is defined, and so this was widely abused, where it was nothing but a kind of a interest on such debentures, and it should have been taxed as an income from other sources. But considering taking the benefit of loophole in the law, this was considered as a capital gain, and extending the period of redemption and paying this returns on only on redemption, this was considered as a long-term capital gain. And instead of taxing at the maximum marginal rate or at a regular rate of income, the same was taxed at a concessional rate of 10%. This was the entire strategy. Now this abuse in the law has been plugged by this amendment by introducing section 50AA, which says that MLD is defined as a security which has an underlying principal component in the form of a debt security, and where the returns are linked to market returns on other underlying securities or indices, and includes any securities classified or regulated as MLD by SEBI. So now this is going to be deemed as a short-term capital gain. Irrespective of the period of holding, this will be considered as a short-term capital gain only, and there will be only cost of acquisition, and whatever expenditure has been incurred will be eligible for deduction, no STT. So as the same is not eligible, it is a short-term capital gain, so the benefit of having a concessional rate will also not be eligible. It will not be liable as an equity instrument and STT, so it will be taxed at a regular rates. Benefit of indexation will be denied, and benefit of reinvestment oriented tax exemption may be possible, as what we are doing under section 50 for the this depreciable assets. This is classic. Here one used to read, just before a few days we have read in the newspaper that a prominent group in the stock market has purchased a property, some 28 residential units in Worli, where the average cost, one works out to be somewhere around some 350 crores. The in Bombay is so expensive, which we just came to know with this kind of, and what must be super luxurious flat. So to generally this benefit of reinvestment of capital gains into residential house property was given to give boost to residential housing sector and to provide a good residential property to an individual. But surely this was not the objective where one can get a substantial capital gains in the market or otherwise. And when you invest in a luxurious residential house property, the entire gain goes scot-free, without any taxation. So now the amendment has come to provide upper limit of cost of new house to 10 CR. You are aware that section 54 gives reinvestment exemption on capital gains when you are selling one residential house property and when you are buying in another, and when you are buying within a period of 1 year before or 2 years after, or getting it construction within a period of 3 years. That was section 54, and 54F talks of a reinvestment exemption when you are selling property other than a residential house. So this here the cost of new house is capped at rupees 10 CR. 10 CR is, according to me, also a substantial amount to buy a property even in a metropolis. And if a person who is competent to buy a property of 10 CR, then definitely he should be even capable of shell out some money by way of a LTCT taxes. So this is what has been happened. So this cap of 10 CR is applicable both under section 54 and 54F. Now you are aware that section 54 requires reinvestment of capital gains into another house. So when you are having a capital gains of 10 CR and when you are investing in a capital gain, when you are investing in a property of up to 10 CR, that entire gain is getting exempted. Whereas what section 54F requires is a reinvestment of consideration as compared to capital gains as given in section 54. So in such cases, though the value of the property is capped at 10 CR, you may get lesser deduction unless your cost of the original asset is nil. Section 54 EC, which you get by investment or in this infrastructure bonds up to rupees 50 lakhs is separately available. It will continue to be available to you. Similar amendments has also been done in capital gains account scheme, where any deposit more than 10 CR is not required, or it will be of no consequence. Now this is interesting. Existing position says that cost of acquisition and improvement is defined to be nil in following cases. Few of the assets which are self-generated and for which there is no cost which can be attributed, say for example trademark or brand name associated with business, goodwill, tenancy rights, goodwill of profession, loom hours, the cost is considered to be nil as compared to zero. Okay, so there is no cost, that is something different, and there is a nil cost which is different. So here the cost is defined as nil. But then also beyond these assets, there were few remaining intangible assets and rights where there was no cost which can be attributed. Based on a famous judgment of B.C. Srinivasa Shetty, where Supreme Court held where there is no cost, the computation provisions fails and there cannot be capital gains. So there were few other cases where there could not be any cost which one can attribute over and above this goodwill, trademark, etc. And where this kind of transfer used to go scot-free based on this B.C. Srinivasa Shetty. So to cover this anomaly, now the section has been amended to cover cost of acquisition and improvement for all intangible assets and rights at nil. So the coverage is wider and encompassing all the intangible assets and rights. So this is a major amendment and one has to consider. Now, in case of interest which you have paid for acquisition of house property, one used to claim deduction under section 24B and also as or under section under chapter 6A under section 80EE. So now it has been provided that if you have already claimed your interest under section 24B or claimed under chapter 6A under section 80EE, then the said interest cannot be added to your cost of acquisition of a house property or cost of improvement of house property. Coming back to 10 IFAOS, receipts on issue of shares, receipt by company on consideration for issue of shares that exceeding the fair market value of the shares from any person including non-resident shall be taxed under IFOS. The similar provision is already there for resident assesses. Now the similar taxability receipt from business trust, I am leaving it. This is something which one would like to discuss. This life insurance policies, you all are aware that whatever proceeds one is receiving from life insurance policy, whether it is an endowment policy, whether it is a money back policy, irrespective of the amount, the maturity of the said policy is exempt under section 10(10)(d), subject to one condition that the premium should not exceed 10% of the sum assured. That is the condition. Now, from 1/4/2024 from AY 24-25, there is an additional condition has been attached that if the premium for policies which have been issued on or after 1/4/2023, where the annual premium is exceeding 5 lakhs rupees, in that case, tax on proceeds less premiums will be taxed under income from other sources under section 56(2)(30). The computation method will be prescribed, which should be similar to ULIP, for which the circular has come into effect last year. However, whatever you are receiving on death of the assessee will be exempt. This is a major thing, and policies taken after 1/4/23 whose premium is exceeding 5 lakhs rupees will be subject to tax under section 56 and not exempt under section 10(10)(d). So if you have taken 2-3 policies where the aggregate premium is exceeding 5 lakhs, then even those policies are exempt. The computation provisions are going to be bit cumbersome, and they will provide as just like ULIP how they have provided with a huge circular. Agnipath scheme, I'm just leaving it. I have given this. This is a very good scheme devised by the government, with this for Agniveers, where this Agnipath scheme has been launched. Whatever has been this contributed by this Agniveers and equal amount of 30% of salary by this government will be contributed to fund, and though it will be considered as a salary for Agniveers, the same will be eligible for deduction under section 80CCH. And however, when after a period of 4 years, when they get this money along with the government's contribution to this Agniveer Corpus Fund, the said amount will be liable for exemption under section 10(12)C, a welcome move to encourage this army personnel. TDS and TCS, I will take, I know I'm running out of the time, I'll just take one or two things. this debentures which have been listed and which are there in your demat account, say for example for perpetual bonds or secured debentures by the companies, which are listed and which are there in the your demat account, the TDS on such interest on securities were not liable for TDS till now. Now the government thought that it goes into under-reporting of income because it is that no TDS is deducted. The assessees are not reporting this income, so they've covered now that exemption has gone. So this interest will be liable for TDS. There is one more thing. Online gaming will be subject to TDS at the rate of 30%, and it will be applicable not only at the time of withdrawal. Every withdrawal, the winning has to be computed, and on that TDS will be deducted. Or even if it is not been withdrawn at the end of the year also, the computation will take place and the TDS at the rate of 30% will be applicable. It's going to be very cumbersome when there are so much of movement of funds. And but this online gaming platform, how techno savvy they are, they have to provide for this also. So it will be net income, and when the payment is done in kind or in cash, then they have to ensure that if the cash amount is less, that they have to ensure that proper tax payment has been done against this winnings. And for this, computation provisions will be prescribed, and certain term, and this will be the entire, and I think one is expecting a circular in this regard. Text on this. TCS on remittances, this I will take it one more. See, now this TCS on remittances, you are aware that it has been introduced. Now this, considering that there is not only basically it was introduced as a reporting move, as a tracker, how the foreign exchange is moving out of the country. Now tasting the blood, the TCS rate has been increased. In case of if the remittances are outside India, if case of overseas tour packages and which are for purposes other than education and medical treatment, it is directly 20% without any threshold. Without any threshold. So if you are taking a package of say 7 lakhs rupees for traveling to USA, directly 1,40,000 rupees TCS will be collected. Of course, we all are aware that it is not going to go west. Finally, you will be able to claim against your tax liability. Even when you are sending money abroad, say for example for gift or for just traveling or for investment or for any other purpose other than education and medical treatment, there was a limit. TCS has been increased to 20%, and there was a threshold of 7 lakhs rupees. So only when your TCS, when your remittance is used to was exceeding 7 lakhs rupees, TCS was applicable. Now even that threshold has been removed. So even for rupee 1 also, you have to face TCS at the rate of 20%. So in case of education and medical claim, there is a threshold of 7 lakhs rupees and TCS at the rate of 5%. There is one more inventory valuation, and as per this special audit which under section 142(2)(a), similar thing, the power has been given to AO to call for a direct inventory valuation by cost accountant to ensure that value is as per the provisions of law. Now, what is going to be the impact of such valuation, one doesn't know, because there is one reporting which has been done in tax audit report, which, as an auditor, you are verifying whether the is proper or not. Under section 145 also, one checks whether this valuation includes this GST and other indirect taxes also. And there is under ICDS also requires proper inventory valuation. Over and above this cost auditor, the power has been given for inventory valuation by cost accountant. This is something a new animal. So that's why I would like to draw your attention. How it will happen, whether it is physical or report. Fees will be decided by government, and section 295 will be prescribing the rules. Now, when there is ICDS to section 145, section 145A, the companies law which requires for true and fair valuation of inventory. This is something new animal which will make the life a bit complicated. And while ending this talk, I would just request the committee to organize one special this meeting only for understanding the amendments in charitable trust, which I have not taken, because even if I consider, if I would have discussed 2 or 3 amendments in charitable trust, it would have taken the entire session. So to give professional services to a charitable trust is no charity, that one has to accept. There are 115 TD kind of TR which involves this taxation on non-registration and very serious implications under tax laws. So before you venture out and give advice to a charitable trust, please be thorough, or otherwise it will be, they will be in deep trouble, and with that also we have to face the music. Requesting this, that this has to be specifically addressed by a competent professional. And I am thankful for giving me this opportunity, and I thank all of you for patient hearing. Thanks.
Thank you, Neena ma'am. Let's quickly move to questions first. Ma'am, one question is there from a member.
Yeah.
Are you able to hear? Okay.
I'm
Ma'am, question is,
so I'm able to
in
hear you.
case of, okay, ma'am, okay. In case of new provision of LIC limit of rupees 5 lakh, is it to be computed per policy or aggregate of all LIC policies?
Aggregate of all LIC policies, but issued only after 1/4/2023. So earlier policies will not be touched upon, will not be considered for the limit of 5 lakhs rupees.
Okay.
Yeah,
Okay.
and what we have to consider is a premium, not assured amount.
Yes, ma'am, only the premium amount.
Yeah.
Ma'am, one question is there. Ma'am, is it solely for the cost auditor or CIMA holder can also do it?
It is cost auditor which has been mentioned.
Okay, only cost auditor has been mentioned right now.
Yes.
Right. Okay. And one, not exactly a question, but I would like to share with you that can we please have a recording or a PPT of this budget session, please? It's very informative and useful. Message from a member, ma'am.
Yeah,
So,
please share it. Please share it.
Okay. Okay.
The PPT has been prepared because I know I could not cover each and everything. So whatever I could have covered, I have taken a pain, and please share it. The knowledge is always for sharing.
Okay, okay. Thank you so much, Neena ma'am. On behalf of all the members, I extend my gratitude to you for such an enlightening session. It was very informative, and I would say that in such a short span of time, you have tried to cover almost all the amendments, which was a very difficult task. But your presentation and the way you covered everything was very nice, and I hope all the members have been hugely benefited today. So thank you on behalf of Young and Women Member Empowerment Committee. I, Mansi Mishra, would like to thank Neena ma'am and all the committee members for giving me this opportunity to be with you today. Thank you, ma'am.
Thanks for giving this opportunity.
Is Abhay Chajir sir available right now? Shanu ma'am, are you able to hear me? Okay. Sir is not available right now. Can we start the second session
Yeah,
Yes,
I think
Rupa
I
ma'am,
yes,
over
I
to
think
you.
yes, please. I think the speaker also is there. So second speaker. So let me introduce the speaker for today for the second session on customs and the changes. Well, Prerna Shah, who is the speaker for the second session. She is a young professional practicing in various facets of indirect taxes, including GST and customs, since the last decade. She's been handling past litigations of central excise and service tax, etc. Also, she has ventured into the real estate sector. She is currently a director of GSC In Time Services, a very rapidly growing firm of Indian origin. She's been a part of various tax firms like Sudit Parekh and Company, MZS and Associates, and Ernst & Young Private Limited. She's been a part of the core committee of indirect taxes at Chamber of Tax Consultants and has been a regular speaker on indirect taxes and has addressed various professional forums like WRC, the Chamber, and the Bombay Chartered Accountants Society, and some other forums. She's also has provided training to departmental representatives at National Academy of Customs, Indirect Taxes and Narcotics. Also, she has authored co-authored the book E-Rulings Under the Indirect Tax Laws, GST Perspective, which was published jointly by the Chamber of Tax Consultants. She's been a regular faculty at various courses, GST courses, and apart from that, she's engaged in social welfare activities through an NGO, which is named as Young Sevak. So with that, where a very a lot of achievements you have made in these past 10 years. So we would like to hear from you on this very important topic. So let us go to Prerna Shah, who will start with her address for the second session.
Thank
Yes,
you so
Prerna,
much,
please.
Rupaji. And thank you so much, CA Institute, to give this opportunity to me. So when I discussed, I think with one of the colleagues of yours yesterday or day before. So the thought process was that let's have something where, people already, all the CAs are into certain traditional practices. But the thought process was to give something which is different from the normal thought processes, and then let's come out with some new products for the clients where we are actually going to give good benefit to the client. Clients' various thought processes or business models can be structured in a way that it can be more tax efficient, it can be more working capital benefit, and sometimes there can be various other benefits operationally also, which can be available to the assessees when they are into imports and exports. So that's how we came up with this topic of customs and FTP and how CAs can do practice in it. So I'm just trying to share the presentation. Let me know if you can see on the slide. Are you able to see the slide?
Yes, we can see the slide.
Okay, great. Considering that I think I have roughly around 45 minutes to go, I had prepared slides which are running into 80s around. What I will do is I'll skip the portion which is pertaining to the procedural aspects or the applications or the nuances of the schemes. I'll just give a brief of the schemes which are available under customs and FTP. And then you can go through the slides whenever time permits, and then you can ask questions also. I have given my contact numbers and email IDs at the end. So in case somebody is not able to understand or wants to discuss on certain queries, then they can definitely come back to me. So with this, let's talk about the customs and FTP. I'm sure all the CAs, we generally, talk about a lot about income tax and indirect taxes when it comes to GST. But when it comes to certain unconventional areas like customs and FTP, we feel that we are not the right persons to handle. It is more of a CHA's job, that they are supposed to do. So today I am going to tell you that how a CA can help these assessees and importers or exporters for that matter, so that they get the maximum benefit. And then definitely, if they are getting the benefit out of all the imports and exports, then definitely they would not mind some amount to be passed on to the CAs. Okay. So what I'm going to discuss today, I have given the topics on the slide, which you can see. So there are various schemes which I'm going to discuss. On my left hand side of the screen, I can see from start that free trade agreements, preferential trade agreements, or the classification or the special valuation branch cases. So these are few cases which I am going to discuss, I would say, in little bit of detail. When it comes to the right side of my screen, which is SEIS, RODTEP, duty drawback, etc., all those things I'm going to talk, I would say, quite in brief. I'll also tell you the reason why so. So when I talk about the schemes which are there on the left side of the panel, all of them are very, very important in terms of the client's savings and also in terms of CA's role. The moment we move to the right side of the slide, that is SEIS, RODTEP, I would say those are the schemes where there can be certain doubts for the assessees, or there can be certain things that we can do. But the first 3 points, that is SEIS, RODTEP, and duty drawback, I would say are more of a self-driven schemes after a point of time. So you don't have to really do a lot of things as CAs, and that's why those will be discussed, I would say, in brief. And other 3 points, which are customs, advanced ruling, reviews, and audits and litigations, I think we are dealing day in, day out on GST and income tax areas as well. So I'll discuss in brief. So my focus areas will be on the left panel, though I'm saying that there is a possibility for us to work even on the things which are put down on the right side of my presentation. Now let's talk about the first topic, that is preferential trade agreements and free trade agreements. I'm not sure if I can get a poll here, but you all can think around whether there is any difference between preferential trade agreement or free trade agreement. If I don't think anybody can answer here, but they can definitely put it in their chat boxes, and then the coordinators can tell us in case there is any response there. Until then, I'll continue the presentation for want of time. So for preferential trade agreement, if you think, you feel always, PTAs and FTAs, we talk normally together, but there's a slight difference in it, which we need to know. Preferential trade agreements basically are preferences which are given by the developed countries, and therefore those can be unilateral agreements also. As against that, if you look at the free trade agreements, those are bilateral agreements where 2 countries come together and then they decide the negotiations. What do we mean really by these preferential trade or free trade agreements? So basically what happens is, I'm sure we all are right now filing GST returns regularly day in, day out, and we all are putting in certain HSN codes, right? So in the initial phases, it was 2 digits, then 4 digits. Now, slowly and gradually, they might shift to 6 digit and 8 digits. 6 digit, they've already, I would say, they've moved. So they will now gradually, they were supposed to move to 8 digits in a year's time after implementation. They're still struggling, and maybe by next year or next to next year, the classification of all the goods, which even when we are looking at GST, it is going to be at 8 digit level. I'm not sure how many of us have wondered, but the question always comes that why do you need this data? Why the government needs the data of HSN level in such a, I would say, important manner? Why they consider it to be so important? So I would say one of the reasons which I can say is the preferential trade and these free trade agreements. Why so? Because when the goods are, within India also, when the goods are consumed, they want to understand the goods and services consumption, how it is happening, how the trade is happening within India also. And that somewhere will help them when they are negotiating the terms with the foreign countries. For example, recently, in last month itself, there was a free trade agreement which was signed between India and Australia. And when you look at the terms of the agreement, when you look at how it is going to be implemented under customs, you will understand that, okay, somewhere, if I am now importing certain goods from Australia, there will be a benefit to me. Okay, and that is why these trade agreements become very, very important. The way there are DTAA agreements, I'm not saying exactly the same way, but I'm saying almost in the similar way, there are free trade agreements which are there in place so that you get the benefit out of whenever you're doing the trade with those particular countries. Okay, so I have also mentioned the examples of the agreements which are there. I have also mentioned how the free trade agreements or preferential trade agreements are moved. So most important thing that you need to know is about the rules of origin here. So if you see, the rules of origin are the criteria which are required to determine the national source of a product. Okay, and it actually helps to determine from where the goods are originating. So what happens is, for example, I am an importer and I am importing goods. For example, let's take Australia itself. I'm importing certain goods from Australia. Now, what I need to look into is that whenever I'm importing these goods, I need to check the customs notification to determine if my 8-digit classification and the description of the goods put together, whether I am able to get any benefit from this free trade or preferential trade agreement with Australia. If I'm saying that, okay, I am eligible for some benefit, in that case, one needs to also then prove to the government that ultimately the good actually originated from Australia. So it should not happen that, okay, it was somewhere, Australia also, the trader who is actually selling the goods to me, if he has also imported goods from somewhere else, and then if he's selling me, then he will not be able to say that goods are originating from Australia. If the goods are originating from Australia, then only I will get the benefit of this particular, I would say, this particular incentive. What is the incentive? For example, that goods was attracting maybe a rate of duty of customs, basic custom duty of maybe 20%. There may be an agreement between India and Australia to say that if I'm importing this particular product, it will be at the rate of 8%. So directly, my duty is getting saved at 12% on the purchase cost. Okay, when I'm importing the entire consignment, I'm paying this 12% less on my purchases, considering that there is a preferential trade or free trade agreement in this particular case. Okay, as I said, the rules of origin are very, very important now. So there is a originating certificate which you have to obtain. The entire process is given here. Once you are able to obtain this certificate from the exporting country, and when you produce it to the Indian country authorities of customs, then you get the benefit of it. I would say from last 2 years, the provisions relating to the rules of origin have become very strict. Earlier it had become mechanism that, you give this certificate of origin and then you are able to get the benefit out of it. But since it was very, very mechanical, the government came up with few provisions and changes in the customs law to make it very important that you need to ensure as an importer that the goods are originating from that country to get the benefit of this certificate of origin, or I would say the preferential trade or free trade agreements. Okay. Now, what are the tips that, so what you can do for your clients, I would say, you need to first of all check all the free trade agreements and preferential trade agreements thoroughly. You need to also check the notifications to understand the quantum of it. So when I talk about it, there are, I would say, n number of notifications which are available on this particular matter. When example I gave was of India and Australia, there is of India and Malaysia, there is India and Sri Lanka, there is India and USA. So you need to check all those notifications very thoroughly. First of all, you need to check what is the exact benefit that you are getting for that particular product. Sometimes the benefit is percentage of the duty saved. Okay. Sometimes rather duty levied, and sometimes it is percentage directly on the FOB value. So you need to differentiate what is the quantum of the benefit that you are getting. In case your client is going to import those particular goods continuously, then what you can look at is, and also he has options from, for importing from different countries. In that case, you can have a comparative chart, including all particular countries, and if you are importing, for example, from Australia, what will be the rate? If the same product of same quality, if you are importing from Sri Lanka, what will be the import duty on that? So then the assessee will be able to, I would say, negotiate from those particular vendors properly, and then he will be able to save the duty, import duty. Yes, year-on-year benefit analysis is also very, very essential here, because whenever there is a trade agreement, the general practice is that they will try to reduce the rate of that particular product gradually. So for example, the same product when I imported maybe in 2019, the duty benefit was only 2%. So if it was 20%, they said, okay, you pay only 18%. But maybe today, when I'm importing in 2022, they have reduced the rate to 4%. So maybe rather they have reduced the rate by 4%. So maybe 20% I am paying now 16%. That also is possible. So therefore, year-on-year benefit or analysis is also important. sometimes you can have two preferential trade or free trade agreements on the same country. Okay, so when I talk about, like I was reading through on Sri Lanka. So on Sri Lanka, you have two free trade agreements. One, which is having one agreement which is signed as a group of countries, and then one which is individually signed with Sri Lanka. So you need to check both the notifications so that you find out the exact or most beneficial exemption which is available to you. The advantage, obviously, as I said, to importer is very, very huge because he's directly saving on the purchase cost. Sometimes your margins can go high, much, much higher if you're only importing from particular countries, and if you're able to get the benefit out of it, you can be competitive in the market. So that's something that you can look at. Or if you're not competitive, then definitely you can make more profit. So either of it is definitely possible if you are able to take advantage of this. So this is a very big area where we can practice and we can give the consultation to clients. The entire approach for us should be that the moment client is saying that they are importing or exporting, or they are going to engage into it, you can talk to client and then you can ask them that I'm going to study everything and I will give it to you. I'll be having hands with you, and I will increase your profit. And that's how you will be able to get advantage of your fees. Okay. Then the next point which I had to discuss was on the classification. In the GST also, as I said, more or less gradually you're going to see 8-digit classification. Under customs as well, it is equally very, very important to have correct classification. So why classification is important? So there are few reasons which I have listed also. The most important part is that you'll be able to get the exact rate of customs duty if you know your HSN code correctly. And this is something which we are doing day in, day out for various clients. Where if they are importing any particular product, I remember one very, very peculiar case. It was a case of, it will be very funny when you will listen to it. It was a case of importing Nimbu Karas. Okay, but it was imported as a cleaning material for the medical instruments. And when we looked at the documentation from the exporting country, the exporting trader, when we looked at the documentation, the HSN code was mentioned differently. When we looked at and when we checked the classification of the product in India, it was different. Okay, and then we had to talk to them. We had to talk to the exporting country and the trader. Then they were not able to change the documentation. But at India level, for the Indian importation, we were supposed to convince the authorities that this is what is going to be Indian classification for these goods. And therefore, they have to accept my classification under India, and then accordingly give me the benefit of the rates which are available for customs. So therefore, this becomes very, very important area to look at the rate, exact rate, and also the exemptions. The anti-dumping duty and preferential duties, which we will discuss after some time, those are also equally important to be checked. If your HSN is correct, then only you will be able to see whether there is any anti-dumping duty on the same product. Not only the HSN, when it comes to anti-dumping and preferential duties, you also need to check the description of the goods. Okay, both are equally, or I would say much more important. HSN generally are indicative in these cases of anti-dumping. You need to look at the description of the goods, which is equally important, and then you need to decide whether there will be any levy or not. So therefore, the classification again becomes important. Exemption, I've already talked about. There are various exemptions. Again, in exemption, as I said, you need to look at not only the HSN, you should look at the description of the goods to determine whether you are getting any benefit under customs. The free trade or preferential trade agreements I've just discussed, I'm not discussing in detail, but that also is completely based on the HSN code that you are looking at. There can be denial of ITC under GST law in case you are paying IGST under a particular HSN code. And then if department feels that you are not eligible for the credit, it is a blocked credit, or you are not able to fulfill certain conditions of the ITC availment, then definitely ITC can be ineligible in your cases. The one more thing which you need to look into is that in case you are unable to classify the product correctly, then there will be less competitiveness for you in the market. We had seen one case where it was a ship breaking case, where the fight under GST was either 5% or directly 28%. So the margin, or rather the rate of GST was differing so much that you had no choice but to do the correct classification so that you are able to get the entire benefit of GST, and you are competitive in the market then. And you also need to look into the other licenses which are available under Indian laws. So if, for example, if it is a primary battery cell, okay, then there are certain other registrations like BIS registration, which needs to be done for the importer, by the importer for those particular goods. when imported first time in India. So in those cases, it's very, very important that your classification is correct so that you know that what all other licenses you need to obtain in India to deal with it. Okay, I'm not getting into the nitty-gritties, but we have prepared slides on how to classify the goods. There is recent change in the current budget on the HSN classification. They have said that if there is 8-digit under the 6-digit code also, it will be a sub classification of 6-digit now. So that's one of the additions which has happened in the current budget. These are general rules of interpretation which you need to know if you are dealing under customs and classifying a particular product. So the first thing says that the headings, for example, if you look at this chart, the first 2-digit of the entire classification starts with the section number, rather the chapter number. Then it is the heading, which is 4-digit classification. Then it is the subheading, which is the 6-digit classification. And then the actual HSN classification of 8-digit comes in picture. Okay, so here if you see chapter which I have mentioned is relating to articles of apparels and clothing, accessories knitted or crocheted. So when I talk about that, the sections, chapters and subchapters are provided for ease of reference only. When I look at the wordings, articles of apparel and clothing, accessories knitted or crocheted, and then I look at the men's or boys shirts knitted or crocheted, then I'm saying of cotton. So all these are only headings which are for references. I have to look at what do you mean or what is written at the 8-digit classification, that is shirts, hand crocheted. If I'm able to fall under that, then only I'll be able to say that this is the classification. Only going by heading, you're not going to get the answer for the 8-digit classification. Then the second important rule is that you need to look into section and chapter notes very, very thoroughly. I've given one example here. Recently, under the WTO guidelines, there was a change in the classification of drones. The camera, which has the drones which have cameras, the classification can be thought as maybe aeroplane or as maybe a camera instrument. So in those particular cases of drones, there was a specific classification which is introduced, and there are specific section and chapter notes which are introduced. So if you don't study thoroughly the latest amendments which have come under WTO guidelines and the HSN and the section and chapter notes in India also under Customs Tariff Act, then it will be difficult to classify the product. Then the essential characteristics of the product needs to be seen thoroughly. So even though it may be an incomplete or an unfinished product, but if it is having all the essential characteristics of a particular goods, then the goods have to be classified under that particular heading only. This example which I have given of this particular judgment is relating to the chapter notes and section notes. This example which I have given on the next slide is on the incomplete and unfinished goods. I'm not getting in detail. In case there is any mixture or combined goods which are put together, then you need to again look at what is the final, I would say, substance or material which you are looking at. For example, I've given here copper, waste and scrap. So it is entirely copper, and therefore it will go under chapter 74, which is relating to copper, and then waste and scrap, wherever it goes, I will just put it there. Okay. If there is a description, or if you feel that, okay, under, as I said, for me, this there was a problem in the cleansing material, that whether it should be falling under the edible chapter of, Nimbu Karas, or should I consider it to be under the chapter which is relating to cleaning material. So in those cases, what this says is, what is the most specific description of the goods under the Customs Tariff Act? I have to check it along with what is the actual goods all about, and then we have to decide if for example, I feel that, okay, it is equally at both the places, then where exactly is the most specific description, I would try to, put it under that classification, and then we can give the HSN code, final HSN codes. Again, I have given certain cases here. I am not getting in detail. Essential characteristics is very, very important. So whatever goods you have, for example, I have given very good example of all-in-one printer here, where you have the printing, you have the faxing, you have now Wi-Fi and Bluetooth and all those things as well connected to it. But what is the essential characteristics of this entire all-in-one printer? It is ultimately a printer, and therefore the essential characteristics remains to be printer, and therefore it has to fall under this. So recently there was also one case law when relating to computers and tablets. Okay, I have these again are just one, I can say one is on the digital clock. When it has the calculator, etc. also, the main important character, it is classifiable as calculator. clock, because calculator was just for additional function which was given. There is also, for example, there was a very, very famous case of fountain pens, which had certain gold plating. Then the question was whether it will fall under the gold products or it will fall under the pen products. And then it was said that ultimately the function which was of the pen only. So therefore, it was then considered to be under pen heading and not under the gold plated. Then one of the other interpretative rules says that whatever is, if there are classifications which are conflicting with each other, okay, and you say that, okay, at both the places, my product is equally classifiable. In those cases, what it says is that you have to look at what is the last classification which comes in the numeric order. So, for example, my product is falling, for example, under chapter 19, which is edible, and also under cleaning, which is 28, for example, chemicals. So in that case, I will go for 28 because that is last under in numerical order, and then I will try to put it my product under that classification. Okay. In case, what happens in case there is an innovative product which is imported in India, which was never imported before, and where there was no entry, under this entire tariff, which is having 98 chapters and lakhs of products. And if you feel that still your product is not covered here, then what will happen? Then in those cases, the interpretative note says that you have to look into which is the akin product to it. So as I have given an example of ball pen versus ink pen. So if the ink pen is imported for the first time, then you will say that, okay, it will then fall under ball pen, even if there is no entry in the HSN. You can't say that since there is no entry, I'll not pay duty on it. You will have to look into which is the akin classification, and then you will put your goods under that, and you will still pay the duty as per that. So in recent cases, we have seen something which is more of a kit, which is going to be imported for testing the blood, which is for a different purposes, never imported in India. And then we might have to classify it under the blood test kits themselves. Thereafter, in case those are the particular goods are imported with the cases, then the cases also, and if the cases are only meant for those particular products, then the cases also will have to be classified along with the main product. Okay, that's what this says. And in case there is a packing material again, then, and if it is normally used along with those particular goods only, then again it will be classified under the particular goods directly. There are these, whatever I discussed until now were all given under the rules of interpretation under customs tariff itself. Now, these are certain principles which have emerged out of the courts normally. Okay. So first theory which is given is the common parlance theory. Okay. Trade parlance, we generally say common parlance theory. So what is it exactly? For example, I have given one of Vico Varajayanti powder and paste. Okay. So in those particular cases, if you see, it is the question was whether it is, Ayurvedic medicine or is it a cosmetic product? So then obviously they said that it is an Ayurvedic and it is not a cosmetic product at all. So looking at how people look at it, people never looked at it as a cosmetic product per se. If you look at Vico, you always thought that it is more healthier option available to you. So therefore they considered it to be an Ayurvedic medicine. Then the other principles also include the dictionary meaning, or there are expert opinions. For example, in certain cases, you might need engineer's opinion to decide what exactly the goods are all about. Okay. And then you might be able to give the exact classification to the clients. There could be ISI specifications for those particular goods. There can be certain circulars or HSN explanatory notes. So the WTO, World Trade Organization, comes up with these HSN explanatory notes, where in detail they talk about every single entry that they have given. What do you mean by it exactly? Sometimes they've also drawn pictures. If you feel that, it is very, very scientific, they have also gone to give you the pictures of it. Okay. And then you have to decide what is the classification. So these are certain parameters through which you have to, take one product. For every single time you want to do classification, you have to look at all this and you have to decide that, okay, the goods will be classified under which 8-digit classification. And then your PTA, exemptions, everything, the rate of duty, everything will be fixed. So therefore, this classification itself is a very, very detailed exercise. And this is a very important area where you can generate assignments for yourself, and the client will benefit out of it, because the CHAs, when they do the classification, they only look at the industry data, where people are going, what people are doing, and then they will just directly, try to fit the product into it. But when it comes to departmental inquiries, and later on, if you have to pay a lot of import duties along with interest and penalties, then it's important that your assessee, your clients should be made aware that if you are importing any new product in India, and if you want, then we can do the classification for you. That's how you can talk to your clients. So what are the ultimate steps for classification? You have to exactly understand the function, material, and market of the goods. Okay, these are very, very important and crucial when it comes to goods. I remember myself looking at, there was a question on brooms. Okay, the normal brooms, and there was an exemption under GST law for the normal brooms, full Bahari Jadu. And then when I look at my product was plastic broom, and which was never imported earlier in India. So then, there was again a question mark that how do you classify this product, whether you are eligible for exemption or not. So understanding the function, the material, the market, everything is equally important when it comes to the classification. You have to study the relevant section in chapter notes when it comes to the classification, as I discussed about the drones. You have to classify product on the basis of general interpretative notes as well, which are available, which we discussed in detail right now, and other principles which are available. And then you have to go through the tariff, you have to go through the preferential free trade agreements and the exemption notifications to determine exact duty structure for that particular product. And I have not mentioned here, but you have to also look at the anti-dumping and safeguard duties. What are the tips when you are looking at this classification? HSN explanatory notes, which I discussed, which are issued by the WTO, those are only having the persuasive value, but definitely it does create some impact when a classification is in question. So you can take help of it as guidance, but it cannot be considered as a rule in India. The industry practice, as I said, could be very different to classify the same product. So you need to be very, very careful. If you are giving a particular classification to client, which is different from the industry practice, then you have to talk to them. You have to make them understand the importance of it. And if required, you can then go for certain other, for example, if you are yet to import, then you can go for advanced rulings or certain other practices you can follow. The understanding of the products and the usage is a must, as I said, about one example of the jadu, the broom, sorry. Then the classification under others. Okay, this is very, very, again, important. Whenever you will look at the customs tariff entries, everywhere in all the chapters 8 digit, you will see others. And then you will actually feel that, okay, my product does not fall anywhere here, and therefore I should fall under others. Okay, so you have to choose your others very, very carefully and wisely. Otherwise, you might be in real trouble. If you ask me, for example, computers, you will not be able to see exactly computer as the word in the entire tariff. Okay, you have to look at it as, okay, data processing machine. So you have to understand HSN very thoroughly, and then you have to do the classification. As I said, long classification may lead to interest and penalties, and penal consequences are really high under customs. So therefore, the assessee needs to be very, very careful while doing the classification, and you can help if you are have expertise in this particular HSN tariff and classifications. It can be of a very, very great help to the assessee to determine their exact rates. Especially when it comes to departmental authority presentations, which I have discussed also, then you can also represent the client, and you can justify that why the goods are imported at a particular HSN in case there is a dispute by the authorities while clearing the goods, or even after that, if you have received a show cause notice. Now, special valuation branch, this is very, very important. You all must be aware of the provisions relating to transfer pricing under the income tax laws. Whenever any company is having any related party transaction, then under the transfer pricing, the intention of income tax is to see that income tax is not somewhere, the advantage of income tax is not taken. So at least the product pricing is done correctly, so that the profits are correctly provided to by the company, and therefore the income tax is not paid less. In the similar way, under customs, there is a special branch, which is special valuation branch, okay, of the customs department, departmental authorities, where they investigate the cases when it is a related party transaction, and if you're importing any particular goods, they will try to see that the import price is correctly given while clearing of the goods, and therefore you are paying the correct custom duty. Otherwise, you can increase the product, rather you can decrease the product price so that you are paying the less customs duties, and therefore there can be evasion of custom duties. So to investigate the matter, what department does is, for every import, when it is from the related party for the first time, you have to fill in the entire questionnaire. You have to then represent yourself before the authorities to justify that at what pricing or valuation you are clearing the goods, what is the basis of the valuation, and you have to also present your industry data, your data of the other similar entities if they have imported from your maybe related party or from other independent buyers, sellers. Then what will be the rather what will be the import valuation, and if there is any difference between the valuation, then you have to justify why so, and you have to at least say that this is going to be your valuation of the particular product, and you have to justify your price, and then you can pay the customs duty. The entire process I have given here because you will be first, I will just discuss about it. I'm skipping all this. Yeah, from here I'll talk about. So what happens in this case is when you are, obviously goods are imported, it's not easy that you will be able to do valuation, or the department will be able to clear or complete their entire investigation in shortest time. So, and obviously you want to clear the goods because otherwise there will be heavy demurrage charges if the goods are not cleared on time. So what happens is, generally there will be provisional assessment which will be done on the basis of which your goods will be cleared off at a particular value. And later on, based on the entire procedure, your own representation, you will be able finally getting a particular valuation. For example, earlier you paid duty at 100 rupees. And at the final stage of SVB order, when it came, the valuation became, for example, 80 rupees. In that case, 20 rupees, you have paid additional duty already. So there can be cases where you might have to ask for refund once you are able to finalize this particular SVB entire procedures. Okay, and there will be show cause notices if the investigation report is able to, so final SVB cell is coming up with an investigation report where it says that, okay, the relationship did influence the price. In that particular case, there will be a custom duty which will be short paid. For example, 100 rupees you imported the goods, and then department is saying that, okay, it was 120 rupees. Then on 20 rupees additionally, you actually are supposed to now pay taxes. So for that, department will issue a show cause notice, and you will have to pay this balance sum along with interest and penalties, if any. And so what I'm trying to say is, this is a very, very detailed exercise. As a CA, your role could be, if the assessee is going to import particular goods, then you can do handholding from the import, or in fact, prior to import, when they are planning to import, you can give them the entire guidance how to import those particular goods. How then you can also represent the client before the department to justify the valuation. And before that, you can do your valuation of those goods on your own, and then that also you can guide to the client. So this is something that you can do as a CA. Yeah, this is very important, that in case there is any change in the facts relating to import transaction, then you will have to again go through the entire procedure of SVB. What happens is, in SVB, it is when you are importing the goods, the proper officer who is actually, clearing your goods will send one preliminary report to the SVB cell, whether this is a fit case for the SVB to do investigation or not. And then SVB will also do its own investigation and then decide whether they want to go for this SVB valuation or not. But more or less, wherever there is a case of royalty, wherever there is a case of any other payment linked after import also, normally there is a case of SVB which you need to keep in mind, and you need to undergo the procedures. Now, these are the tips which I can give you to handle these kind of cases. One, as I said, valuation you need to examine beforehand, before the import are taking place. As I said, majority of the cases where there are royalty or any other payments which are involved, you need to really see whether those particular royalties or payments which are done as a condition of sale of imported goods or not. So, for example, you have imported some goods from Vietnam. Now, when goods are imported, one of the condition of the agreement is that once the goods are imported, once those are manufactured, when I sell the goods in India, at that time I'll pay some royalty, for example, 0.25 rupees for every 100 rupee product which is being sold. Okay. Now, if this is the kind of arrangement between me and the foreign country, the question will come whether this royalty to be included in the valuation or not. So you may think that, okay, this is as a condition of sale, so you should be included, etc., etc. But please understand that here the royalty which is being paid is on the sale of output which is being sold in India, and not a royalty which is on the import of goods. So there is a de-linkage between these two events, one the import of the goods, and then manufacturing and selling in India. So if that is the case, then you may say that, okay, these royalties are not part of my valuation, and therefore to that extent you can save, I would say, heavy amount of custom duty on these royalties and other payments which are being paid. Yes, the similar industry, similar nature of facts, or the similar products, if you are able to get any legal precedents, then your case could be easier. You can take it while preparing the draft submissions and then representing yourself before the authorities. It will be very, very important that you import the first lot in very, very small value, so that you are able to go through the process. This takes 3 to 6 months time. So always we suggest client that you please import it well in advance. Look at your small lot, how your entire valuation is going, and then you start importing regularly from those particular countries. Import from different countries would require SPV procedures to be followed separately. That's also equally important. So if you're importing from, for example, Vietnam, as I said, and then you are importing the same product from UK, then you need to again go through this procedure, because there could be different entities from which you are importing. It could be related. Okay. Most importantly, many times this is missed by the assessees, that even if it is sole distribution or sole agent, you are a sole distributor or sole agent of foreign entity in India. Okay, in those cases also you become related, and this SAB cases will apply to you. So these are few tips which I can give you, where you can have an edge over the others, and then you can try to handle these SVB cases. So this is again similar to transfer pricing, as I said, and you can have a good amount of fees when you handle this kind of cases. Manufacturing under bond. This is again very, very important concept. I will just touch upon in brief. I understand that I'm only having further 10 minutes to complete my presentation. So I'll just skip this entire scheme. I would just say you can go through the presentation. It is, I would say, self-explanatory in most of the cases. I'll just talk about this, that there is no export obligation under this scheme. This scheme is actually beneficial to whomever is importing, then manufacturing in India, and then either he is exporting or selling in India. Okay. Even if it is a domestic sale, this mover can be beneficial to you, but provided you are importing. Okay. So if you are importing, for example, regularly, and then you are manufacturing, thereafter you decide whether to export or you domestically sell. But what happens normally, if you import, you are paying the import duty. In this mover case, you have to take a private bonded warehousing license under this scheme of 2019. Once you take this license, you will be able to import goods without paying a single penny of customs duties. You have to pay customs duties only when there is a domestic sale. So if you are exporting, importing and exporting, you can directly go under the scheme. You don't need to pay any customs duties. Of course, taking license and having a documentation is very, very important and crucial here. But once you have taken the license, then it is much better as compared to the scheme of EOU, which we will see in some part after some time. So this is a very good scheme which has come in 2019. I would say many relaxations are given compared to EOU scheme here, and therefore this has now become very, very popular for various clients. If they want to hedge upon their working capital, then they can save their customs duties. They can import, they can put the entire, all the inputs in the godown, which is licensed as a private warehouse under mover. And only when they have to manufacture, after manufacturing, only when they want to sell the products in India, then only they have to pay the duty. As I said, there is the benefits, major benefits are that you will not have to have any export obligation. You are importing 100% domestically, selling, still it is okay. You can go for the scheme. There is no requirement to maintain any positive net foreign exchange also. So again, as I said, importing and domestically selling, no problem. Working capital benefit definitely is there. Capex cost can be reduced at initial stages, because even when you are importing capital goods, you will not have to pay custom duty on it. Only when you are selling domestically, then you will have to pay custom duty on it. Certain export benefits like RODTP duty drawback, you may not be able to take. Job work so there are circulars which clarify certain things on the job work and FTWZ related procurements. Trading can also be done under mover, but of course you have to maintain the documentation separately. The proper documentation under mover is a must. And that any customs, if you will see all the slides, it's very, very common point. The procedures and documentation are the key to get any benefit under customs and FTP. The timelines to obtain this license is very high. It's 3 to 6 months. So again, you have to plan in advance to get this license. But once this is done, and once your manufacturing plant is considered under this scheme, then you will be having a very good working capital flow, which you can maintain from the customs angle. Free trade warehousing zones. So what we discussed earlier was mover, where it was either the manufacturing or trading if you are doing after, rather manufacturing or processing if you are doing from after import, then you can go for mover scheme. But if you are not doing any manufacturing, you are not doing any process, you're just packing the goods, for example, and that's not considered to be process. Okay. So in that case, what do you do? Then in those cases, you can go to this FTWZ scheme. If you're importing and if you're then you want to save on your working capital cash flow relating to the customs duties, then you can import the goods. You can deposit your goods in a warehouse, which is free trade warehousing zone. Okay. There is a particular zone, which is, demarcated as FTWZ. And then you can deposit those goods in those warehouses, and you can only remove when you want to sell in India. And then at that time you pay the duties, and it is available for trading purposes specifically. What I want to tell here is FTWZ is a special economic zone only, but it is kind of for trading, not for manufacturing. That's the difference between normal SEZ and this FTWZ. Okay, just I'm not talking. What I would like to discuss is only 2-3 points here. Yeah, if the importer is not engaged in manufacturing and if they want to maintain their working capital cash flow, then this can be done. Here, FTWZs are very few across India. Okay, and you need to also look at your logistically how your goods of the importer is moving across India for distribution. Then you will be able to figure out whether this scheme is beneficial to the assessee or not. You have to take warehouse on rent in the FTWZ. So the procedures, the rent, everything differs from FTWZ to FTWZ. So you need to really figure out which one is best for the assessee. You need to also check the facilities, because operationally, whether they are keeping the goods safe, if there is a perishable goods and whether they have cold storage or not. So those things also you will have to check when you're looking at this FTWZ. There is very less awareness of FTWZ. One of the reasons I think is because there are hardly any provisions under the law for FTWZ. There are only 2 provisions in SEZ Act also to talk about the FTWZ concept. Okay, so there is less clarity on the subject, and therefore there is less awareness on FTWZ. But once you're able to see the benefits of the scheme, then whoever is the importer and doing trading in India, they can definitely look at this as a benefit. SEZ, I'm just skipping, many of you might know that it is deemed to be outside the custom territory of India. I would just like to say that the custom duty here is payable when the goods are supplied from SEZ to DTA. Otherwise, and obviously IGST also, there are provisions relating to GST, which I would like not to discuss right now, but it is there on the slide. For SEZ, there are numerous conditions. There is entire act, the entire rules and regulations which the SEZ unit or the developer has to follow. So therefore, this is a little cumbersome procedure which one person will have to undergo on monthly, on annual, on quarterly. There will be returns which you will have to file as SEZ. You will have to maintain your positive net, cash foreign exchange flow. And therefore, this SEZ, I would say, is a good scheme. But then there are drawbacks to the scheme unless you are going to be more focused to be, exporting out of the country. It will be very difficult for you to get the license under SEZ. Yeah, now SEZ regulations which are done in India, those are going to get soon replaced by this Desh bill. The reason is there are disputes with WTO. The same way there was dispute in MEI scheme, there was dispute in SEZ also. And therefore now India is coming up with a different scheme, which is Desh scheme. In Desh, you will not have any net foreign exchange condition, which is there under the SEZ. There will be no custom duty on the domestic supplies also. So we are awaiting more details on this bill, but definitely this could be again a very good scheme. So the assessee has to decide whether they will be fit for FTWZ, fit for mover, or they have to go for this SEZ unit. The very important aspects for SEZ is that procedures and documentation are very, very important and crucial for setting up and also exiting from SEZ. While exiting, you have to pay the duties also, which you might have deferred while importing the goods. And you have to get a clearance certificate from Development Commissioner of SEZ. So every time, for every major procedure or even smaller procedure, sometimes you have to approach the Development Commissioner of SEZ, and therefore it becomes little challenging for you. There are operational hassles for receiving goods to within that particular SEZ and also removing goods from there. So you have to follow the entire procedure, then only you will be able to do so. So this is little more procedural in nature. EOE is a dying concept, so I'm not discussing much. There are hardly few, there it is a very good scheme, definitely. But considering that mover has also come, there are benefits available under other schemes which you can explore. I would not suggest that somebody should go for EOU, because similar to SEZ, in EOU also you have to do a lot of compliances. You have to file returns on a regular basis, and the GST benefits which are available for other schemes, that also is not completely available for EOUs. Of course, there is a limited purpose that it is treated whenever you are sending goods to EOU, it is considered to be deemed export. But apart from that, major benefits are not available in case of EOUs. You have to fulfill again the net foreign exchange gains, rather for a net foreign exchange positive NFE need to be maintained, and some portion of EOU will have to also look after that they are fulfilling that export obligation which is required to be done. There are interpretational issues and litigations which are going on for EOUs under GST law for past periods. So therefore, again, as I said, in EOU, it's little challenging. And as I said, exiting from EOU again, similar to SEZ, is going to be very, very procedural. In one of the cases where we handled it practically, they were not having certain documents for the past period. Like, for example, I had taken license in maybe 2000, and maybe 2023 when I'm surrendering, they will require the documentation for all 23 years. If the company does not have all the documentation, even if you wish to pay interest and penalties, you will not be able to get out of the scheme. So this is a very, very big drawback of EOU. You need to have a documentation, stronger documentation in place if you want to go for this structure. Advance authorization, EPCG, I can only say that in case you are importing certain goods, either inputs or capital goods, and if those particular goods are used in manufacturing particular goods which are going to get exported, then this advance authorization could be very, very important for you. You need to have a minimum value addition normally of 15% to get this advance authorization scheme. What is the benefit in if you have this license of advance authorization? Then while filing your bill of entry for import, you will not have to pay any customs duty, basic custom duty. Only and at the time of export also, obviously you will only put down that it was exported under advance authorization. You have to fulfill the export obligation which is given under the license, and then you will be able to comply with the scheme. You don't need to pay any custom duty on the import during that time. If you are importing under advance authorization. If you have EPCG, if you want to import certain capital goods from outside India, and if you feel that you are going to then use this entire machinery for manufacturing goods which are going to get exported, then you can take again the benefit of this EPCG scheme. I have given the details of the scheme on the slide. In case, again, here the documentation plays a major role. I remember one particular case where they were not having entire documentation, and therefore we could not even complete the procedures for closure of EPCG license. So you have to be very careful with it. Of course, now considering Make in India, even if there is an indigenous sourcing of capital goods by EPCG authorization holder, then he also gets the benefit of deemed export. Now, what are the important points for these particular things? That, as I said, you need to prove that whatever goods you imported, those are the goods which are used in manufacturing and export. So therefore, batch-wise maintaining of the goods records is very, very crucial here on a regular basis. Like advance authorization, if you ask me, it is 18 months that the authorization runs normally. EPCG license actually goes for 6 years. So you need to be very careful with the actual user condition there. The documentation is very, very important. Since it's a long-term scheme, your continuous monitoring of the schemes and licenses are important. You have to have the endorsement on the back of the licenses regularly, and now on the online portal as well. The hassles in getting old data, which I've explained in EOU, happens in EPCG licenses as well. The closure of advance authorization and EPCG licenses is very crucial again, where you need to put in the data properly. And there'll be huge penalties if you're not able to prove that the goods which are imported are used ultimately in the goods which are exported. So therefore, you have to be very, very careful with all the conditions that you are able to fulfill. Then you should surrender. You should, because the goods will be mentioned in the license. The entire procedure is given. There's a detailed procedure given in FTP as well. And of course, there are customs notifications to it. Anti-dumping duty, safeguard duty, I would just say that there is again the entire process of 3 to 6 months here. What happens is, if you feel that your client is importing particular goods from any particular, rather is domestically selling the goods, and there are other players in the market who are importing goods and the goods are actually dumped from outside country, then in those cases, the association or your own client himself can go to department to say that please levy anti-dumping duty on this particular product. Okay. And once you apply, then department or customs authorities will actually check whether there is any injury to the domestic players in the market. And if so, then they will levy the anti-dumping duty. So what you can do as a CA is you can help those particular clients to entirely file the application of anti-dumping duty, that why anti-dumping duty or preferential duty should be levied on particular product, not preferential, safeguard duty should be levied on a particular product. Like you must be aware of Chinese toys, which is a very classic example, which you all must be aware of. Now, these are certain schemes which are SEIS, RODTEP, the duty drawback, the customs advance ruling, review, audit, and litigations. So SEIS is a scheme where if you are exporting services from India to outside India, or within India also, if you are able to get servicing to a customer who is out from outside India, in few particular specified cases, if your description of the service matches in SEIS scheme, then you will be able to get the benefit of it. The rate of SEIS incentive is ranging between 3 to 5% of your whatever is the value of the service. The RODTEP scheme now is in replacement of the MEI scheme, where again the assessee can get the benefit of RODTEP between 0.5% to 4% depending on what is the sector and what is the product that they are exporting. So if they are not taking these particular benefits, you can advise your clients and then you can get them help them to get the benefit of it. But as I said, the procedures here are very simpler. So therefore, this is something that once you're done this basic setup for the assessee, then they can do it themselves also. So there's hardly few opportunities available for CAs, but you can still help the assessee to determine whether SEIS will be available or not, and then guide in the initial phases and do the hand-holding. Duty drawback, when the goods are imported and re-exported after use, or if the goods are exported directly, then in both few cases, you get the duty drawback benefit depending on what is the product, depending on when it is exported. And for example, if it is exported within, after no use at all, within 3 months, then you can get duty drawback up to 98% of the duty which you paid at the time of import. Okay, so those are peculiar cases which you can look into. Now, under customs, when you are importing any particular goods, if you feel that you are not very sure what is going to be the rate structure or the value structure, you can go for advance ruling there. You can help the assessee to go for advance ruling. This advance ruling is much better as against GST. Now, there are 2 benches, one in Delhi and another in Mumbai, for advance rulings under customs. So you can approach depending on your jurisdiction, and then you can get the advance ruling, which then department has to accept as import. Price or valuation or the rate. Now, what you can do for clients is also the review on a regular basis of, if your client is continuously into import and export, what you can do is just give them that, okay, the way you look after their income tax and other compliance of GST, you can tell them that I will also include the customs element in it. So you will then look at their documentation as far as the HSN of the import export goods are concerned, the procedures which they were supposed to follow, the documentation, the submission of the returns, as I said, if you are into SEZ or BOU, your amendment to the shipping bills or bill of entries, or looking at the scripts which are available on the IceGate portal. So all those things can be included in your customs review on a regular basis also. And your customs audits and litigations can also be handled by us if we are aware of the entire customs law. We can review the client's facts and the legal metrics, and then we can represent them before the department. I think this I would just give in brief in 2 minutes that if you want to handle customs and FTP assignments, I have discussed so many products which we can do for all the clients which we have. You need to have the conceptual clarity of each and every scheme that we discussed. You need to be updated with customs law and FTP, because those are again rapidly changing in line with WTO and other things which we need to look into continuously. The penal consequences are very high under customs and FTP, and therefore you need to be aware of it very, very clearly. The procedures and documentation have to be very strong when it comes to customs and FTP. The time sensitivity is equally important here, considering that the goods, if are stuck on the port, then the demurrage charges are extremely high. The SSEs cannot afford it. And structuring the business models, keeping in mind the pain points of the SSE would be very, very important when it comes to structuring or restructuring of the transactions from customs and FTP. So with this, I would just like to end the session. But with a start, you don't have to be really great to start something new, but you have to start to be great. Okay, so you need to start on this customs in FTP. So thank you very much for wonderful hearing from you all, and I'm so sorry that I stretched a little bit of my time. You all can go through the slide, and in case you have any questions, I'll be happy to resolve that. Thank you so much.
Yeah. I'll just take up the questions before I give you the hearty vote of thanks for today.
Sure.
So one question from one of our participants is, what are all the documents and laws relating to import, export for incentives and procedural aspects of any goods to be carried in India?
Oh my God. As I said, for every scheme, there is entire procedure which is prescribed. I have put it under my, I would say some basic portion, I have put it under my slides also, which you will see. For example, if you ask me for taking the license under mover, then from the documents of the director's personal proofs, you will be required to show that, okay, this is what the company prospect is. Okay, this is what you are going to import. For example, if you ask me advance authorization, then you have to put down an entire application with the goods. Okay, this is the HSN code. This is the description of the goods which I'm going to import. So every particular import and export that you are doing, you will have to look at specific documentation depending on what you are doing. But normally, the bill of lading is very, very important document. Then your certificate of origin is equally important document, and your shipping bill or bill of entry are important. And if you are having any advance authorization or any EPCG licenses, then those numbers needs to be put down clearly in the bill of entry and shipping bills to get the benefits. So this is something in nutshell that I can tell you.
Okay.
Yeah.
I hope this addresses the question of the participant. I think we don't have any further questions, but we have two comments for you. One is that Prerna Shah is always very informative in terms of knowledge sharing. That is from one of the participants. And the other comment we've got is the webinar is very informative, and it has been covered. It has covered a lot of topics effectively within a very short span of time. So that is the two comments that we received from our participants today.
Thank you so much.
Coming to the pleasant task of giving a vote of thanks for our speaker for today. As Preeti Savla said in the session at the start, that the committee has now been named from Women Empowerment to Women and Young Empowerment Members Committee. So I think our speaker, CA Prerna Payal Shah, is the perfect example for the young and the dynamic, in whose introduction we saw had a lot of achievements at such a young age. So I think this will keep a lot of us motivated as to achieve something like that you've achieved in this 10 years
I
of
don't
your
think
career.
I'm so big, but I'm definitely sure that we all have great opportunities ahead. And as women, or even as a young member, or both of them to put together as like me, I would say we have wonderful opportunities. This is a very great era where we are living in. Being at office, I'm able to speak to you all. Being at home, you all can work a lot. So I think it's a wonderful era where we are in, and the opportunities in India are immense. So let's have pleasure to look after for our clients. And let's be benefited.
With this, so I would extend my vote of thanks to you in a virtual manner today for your extremely lucid presentation with practical examples and tips as to how one can tips as well as products as to how one can practice in customs and FTP. So thank you for covering this whole big session in a short span of time of 45 minutes. But overall giving emphasis wherever required. So thank you so much for a lucid presentation.
Thank you
CA
very much.
Paisha.
And thanks to you
Yeah.
all.
Yeah, I also would like to thank CA Preeti Savla, the chairperson of this committee, and Sir Abhay Chajirji sir for being the vice chairperson of this session, and all the participants for being present for the most dynamic Sky High Symposium 41 sessions with both our speakers today. So thank you so much. Thank you, Payal, for the wonderful session.
Thank you so much, all of you. And I'll be sharing the presentation with ICI. They can share it then with you all.
Surely. Thank
you.
you so much. I would now request the technical team to please end this session.